question is this: is Japan's weak yen becoming a credibility test rather than just an intervention story? The market answer was uncomfortable. The Nikkei 225 fell 123%. Topics dropped 227%. Dollar yen stayed high, near 162. 5. That combination matters because it breaks the simpler story investors have used for much of the weak yen trade. When the yen weakens, investors often look first at exporters. A softer currency can lift overseas earnings when they are translated back into yen. But today, the equity market did not behave as if currency weakness were a clean support. The sell-off says investors are starting to treat the yen as a policy and confidence signal. That is the change from yesterday. On July 8, the weak yen was still being discussed partly as a financial sector opportunity. There was interest in yen bonds. There was interest in Japanese asset managers winning mandates from global investors. The currency story had a business angle. Today, the same theme looked more fragile. The top stories were still clustered around foreign exchange and financial policy. One highlighted the market probing intervention risk. Another focused on Japanese fund managers buying yen bonds as Bank of Japan normalization lifts yields. A third connected yen weakness with Japan's debt burden and policy credibility. The tension is that those stories can be bullish and bearish at the same time. Higher yen bond yields can make Japan more investable. For years, global investors had little reason to care about Japanese fixed income. If yields are now higher, yen bonds can become a real allocation again. That can help domestic asset managers, brokers, and banks. But higher yields also raise the standard for equities. If bonds offer better income, stocks need a stronger earnings story. And if the yen is falling because investors are worried about fiscal or policy credibility, then currency weakness stops looking like a gift to exporters and starts looking like a warning light. That is where today's stock to watch comes in: Mizuho Financial Group. Mizuho is useful because it sits in the middle of the policy normalization trade. Higher Japanese rates can support bank net interest margins. A steeper domestic yield curve can make the banking story more attractive. That is the constructive side. The risk side is bond volatility. When yields rise too quickly, investors start asking about valuation losses, duration exposure, and capital strength. For a major bank, the same macro shift can be both a profit opportunity and a balance sheet test. So Mizuho is not just a bank stock today. It is a lens on whether Japan's normalization story is orderly. If yields rise because investors trust the policy transition, financials can benefit. If yields rise while the yen keeps weakening and intervention risk rises, the market may demand a higher risk premium. The broader takeaway is simple. The Japan trade is not over, but the reason to own it is changing. The weak yen alone is not enough. Investors now need evidence that Japan can manage three things at once: currency pressure, higher domestic yields, and equity market confidence. Until that evidence is clearer, Japan remains investable, but more selective. The next phase is less about buying the whole week yen trade and more about choosing